For the next hour, you'll be leaving the show me state and entering the show me the money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to help reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about markets, inflation, and what retirees should do in 2026. 5 retirement risks that didn't exist 20 years ago. Also, how to prepare for potential inflation this spring. And finally, 7 risks your retirement plan must address. My name's Jeff Shade. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Jake Floyd of Floyd Financial Group. Good morning, Jake. How you doing today?
I'm doing great, Jeff.
Always glad to hear that, Jake. And I will say one last time, Happy New Year. I'm sure you've probably heard that a time or two in the last 10 days or so, haven't you?
Yeah, absolutely. Happy New Year to you too, sir.
Appreciate that, Jake. Do you make New Year's resolutions at all?
I try to, but my family doesn't like to do it, so I try to get everybody around me to make New Year's resolutions. I'm like, so what's your New Year's resolution this year? And everybody's like, crickets, nothing. So no, I always want to start a new year trying to do things better than I have done them before. And obviously people that know me know I could stand to lose a little bit of weight, so I'm working on that. I'm down about 12 pounds so far. So
good for you.
It's good on those first few days, but yeah, we got to stick with it. But I think New Year's is a good reset time to kind of reevaluate everything. And even if you're unsuccessful in maintaining those commitments, it's still a good reset to try to get yourself back on track.
Yeah, and I think at the top of the list for a lot of people is losing weight. It's at the top of my list, certainly. I'd like to lose 40 pounds here, but I think the way to do it is not say I'd like to lose 40 pounds, but to say I'd like to lose 40 pounds by this particular date and then set some incremental goals, such as in January, I'd like to lose 5 pounds. Here's how I'm going to do it. And then February, I'm going to do it like this. So come up with a plan and then reverse engineer those goals, and I think you'll be a lot more likely to achieve them. Jake, let's get started with our show today. This being the 10th day of January, we're talking about what's happening in the markets right now, and more importantly, what it means for retirees and investors in 2026. Reuters is reporting that investors are flagging something that they call AI-driven inflation. Markets are optimistic about technology growth, but there's some concern, Jake, that it could actually push inflation higher. How does something like that happen?
Yeah, so this is something we've talked quite a bit about on this show. If you've been a long-time listener, you'll know that I think the exact opposite of this. In fact, I think it's going to cause such a massive amount of deflation that the Fed will be forced to lower interest rates. However, in the short term, the way, in my opinion, that it could cause some inflation is simply through asset prices. As the stock market goes up, people have more money. As people have more money, they're willing to pay more for certain things. When we shop for things or when we buy things, we say yes or no to items based on the percentage of money it costs us of our total that we have. If you have $100 to go grocery shopping and you want to buy a steak, you're probably not going to spend $50 on that steak. But if I give you $1,000 to go grocery shopping, $50 for a nice steak might not be the end of the world for you and your family, right? The same math is true in the stock market. And so in the short term, we could have a little bit of inflation, but honestly, that's really not showing up in the numbers at all. In fact, the numbers have been running low on inflation. So one thing and we're going to talk about Mr. Ray Dalio here in a second, but when we're talking about these people, you have to understand that generally speaking, the talking heads at hedge funds or fund managers or analysts in many cases want to tell you the opposite of what they really think because they need you to be the bag holder for whatever trade they're trying to execute. And so what that means is let's say if Ray Dalio, for example, thinks that AI is going to go to the moon and it's going to go straight up, he doesn't benefit in telling you that, because you're going to get ahead of him in your trades. You're going to get in, and then he's going to have to pay more money for those stocks. Versus if he tells you, hey, the run's over in AI, don't mind what I'm doing over here buying up AI stocks. You should maintain a well-rounded portfolio, yada, 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 which is not necessarily inaccurate, right? It's just that these people have big ulterior motives that we need to think about. And while I do think the inflation question, there might be a little bit of inflation that we might not have had otherwise, I think the overall deflationary environment will far outpace any inflation that comes from AI.
So Ray Dalio of Bridgewater says the AI boom may be entering bubble territory. So are you saying that Ray Dalio maybe thinks entirely the opposite?
So I think Ray Dalio should get into coin flipping because he would be accurate more often than he is doing what he does. So what I would say is Ray Dalio has an awful track record, but a lot of that's because he's trying to direct the market with his speech, like I was just talking about. So he says we may be in a bubble, yada, yada. We're always in some type of bubble. The question is, are we 90% inflated or are we 20% inflated? Because this thing on AI is definitely going to get overcooked at some point, but I really don't think we're there yet. If you look at all the indications of where everybody's at on AI, all the places it's proliferating, nobody can get enough chips. Everybody wants the best, wants more. I don't think we're into the bubble territory yet. That will be an appropriate question to ask as we go through here, and it's not wrong to think about that. At the same time, I just don't think that we are that close to the height of this thing yet. When we do get there, it will likely be pretty spectacular. Right now, all these companies are trading at very fair multiples given how much cash they're bringing in. When we start to see the valuations get stretched, that's when I would start to get more concerned.
Talking with Jake Floyd of Floyd Financial Group, and we're talking about current event headlines. If you want a clear picture of your retirement in today's market, call 417-889-7233 and ask for your Floyd Financial Group retirement review. There is no cost and no obligation. 417-889-7233. Let's continue, Jake, here. Axios reports that retail investors are selling and becoming more selective. What does that tell you?
Well, what I would say is retail investors had a very rare year last year where they absolutely smashed institutional investors, because the average retail investor in April saw it as a massive buying opportunity when the market was off 21% in 6 weeks. And a lot of the hedge funds just took their ball and went home. In fact, some of these guys that manage $50 billion and up underperformed the market by 5 to 10% last year in a year that was a relatively steady year. When we're thinking about what retail investors are doing, I think it's important to know that in context, because in my opinion, what's happening is retail investors are simply taking some profits because they had a great year last year. Most of the time, hedge funds and institutional investors just beat the crap out of retail investors. In fact, over a really long period of time, the average institutional investor is like 11%, the average retail investor is like 3%. And that's because when you're managing your own money, a lot of times you're selling when you should be buying and you're buying when you should be selling. An institution generally is emotionless about how they're investing, versus when you're managing your own money, it can be very emotional. I am not super worried about retail investors selling and taking some profits. I think that's a good thing because they hadn't had a lot of great years prior to last year. 2022 was very tough on retail investors. 2023, they were all out, even though the market was ripping. They were due for a good year. They got a good year. I wouldn't read too much into that.
Hitting the headlines here with Jake Floyd of Floyd Financial Group. Jake, MarketWatch says that we may see more Fed rate cuts in 2026, but the timing is unclear. How do you think retirees should think about interest rates right now?
We have not got the Donald Trump next pick report just yet on who the next Fed head is going to be. I think that's going to be instrumental to the next rate cut. So our next Fed meeting is on January the 28th. I think it's likely we will not cut at that meeting, barring anything unforeseen. However, I do think it's probably likely we will cut in March. We'll likely have the next Fed pick by then, and whoever he picks is going to be very much biased to cutting rates. This whole thing with Venezuela and Maduro is going to have a giant deflationary effect on things as we pump the oil out of Venezuela and get it online. That's going to reduce the price of oil further, which is an input cost to everything, which means we're going to have prices coming down based on that as well. So I have a very detailed thought process on why I think the inflation fears are way overblown, but we'll leave that for when you come in and see me at your meeting. But I think that as we're thinking about rate cuts, I think January, probably not. March, I would say probably yes, we will get a cut, which is a little different than what the FedWatch tool is predicting. So far, what's priced in the market is a cut in April, a cut in July, and no more cuts after that. So we'll have to see if that remains accurate or not.
And lower rates can be a double-edged sword as well, too. They often help stock prices and bond prices, but they also reduce yields on CDs and savings accounts, so keep that in mind. Let's talk about bonds possibly making a comeback. Jake, are bonds finally useful again in retirement portfolios?
Yeah, I think so. I think that bonds from 2010, let's say, to 2022 were absolutely atrocious, just terrible. And we were looking under every rock for an alternative. But because of how bad they were then, they're getting ready to make up for some lost time. And as interest rates fall, that's good for bonds. So the answer is yes. I think bonds are generally a good investment here. And as long as you're willing to stay the course, I think there could be quite a bit of appreciation in those bonds as interest rates fall, as well as the yield that you're getting. Savers are the ones that are hurt by lower interest rates. Pretty much everybody else, though, benefits. You have to be willing to shift your mentality on what it means to save money in an environment with perpetually low interest rates. Now, I'm not saying we're going to have perpetually low interest rates, but that is a possibility. And I think that interest rates coming back down is generally a great thing for investors, property owners, bondholders, crypto bugs, gold bugs, but savers not so much.
Jake, Yahoo Finance reports that gold and other safe havens are gaining traction again. Do we still have the same opinion about gold as we always have?
So generally speaking, the higher gold goes, the less I like it. And to be fully transparent, I have obviously been wrong on gold. I don't really love gold as an asset class. Silver has been going absolutely insane. The average move daily on silver now is like 3 or 4%, which is just insane amounts of volatility. If we want to talk about bubbles, I would say silver is definitely in a bubble. Silver is just going crazy. When it pops, it's going to be ugly, but that doesn't mean it can't go to 100 or 120 an ounce first. It's not a place where I want to play. I don't know that it's a place, if as a retiree, that I would want to play, just simply because it's so volatile. Silver is 10 times as volatile as most of the tech stocks out there right now. It's just crazy. So again, congratulations to those who have been in gold and silver and other precious metals. But I'm still probably on the sidelines, and I'll probably remain there. And again, the higher it goes, the less I want to get in there, just because it's more room that it can fall or less potential gain. So it's also, for those who have not heard the show before, the main reason I don't really like gold and silver is because it's very transactionally based. So if you go in and if you have $250,000 worth of gold in your retirement savings and you need a month's worth of income, what do you have to do? You have to go sell it at your local shop, which is kind of a pain in the butt. But more importantly, you're going to get charged a 5 to 10% commission every time you sell it. That makes it very cost prohibitive to use it for income, in my opinion. There's other ways to get exposure to gold and silver markets rather than holding physical. Some people don't mind hassle. Some people go Black Friday shopping at 6 a.m. and they think that's the greatest thing ever. Personally, I want to be at the opposite place of wherever those people are.
Me too.
And so that's generally asleep at home in my bed at 6 a.m. on Black Friday.
Absolutely.
I try to avoid crowds and hassle. What I would rather do is have a situation in retirement where I just wake up, there's a check in the bank account, I use it to live on. My money grows as we go and offsets the money I'm taking out of my retirement savings, and I sail off into the sunset, and when I'm done with it, it goes to my beneficiaries according to a trust or however we set that up. And so to me, that's easy and no hassle. That's kind of how I try to set up my plans for people's retirement.
100% with you, Jake. Let's wrap it all up here by talking about Social Security again. It's not breaking news, but we keep hearing that Social Security benefits are being eroded by taxes and Medicare premiums and COLAs that don't match real expenses. I was talking to you about a situation in which someone got a Social Security statement that said that their Medicare premiums were going up, and despite the COLA increase, they actually were receiving less money. Is this of great concern, do you think, for people to really be worried about?
One hand giveth, the other taketh away.
Taketh away. There you go.
And I would say if you have a smaller Social Security check, this could be the case, but you would have to be at $500 or $600 a month Social Security. Right. I'd say the average person, their Part B premium is going up, but their COLA is going up more than the Part B is going up, maybe double or so. But let's just be honest. None of these numbers are based on facts or cost or anything. These numbers are just totally fabricated. It's a little bit of a slap in the face that they expect us to believe that these COLA adjustments reflect real inflation. That would mean that since 2020, total prices are up something like 27 or 30% or something. Most stuff is double. Some stuff is triple. It's way higher than that. They're trying to figure out how little they can give away with increasing Social Security because they know it's broken. And so once they fix that, which will probably be a major topic of discussion at the 2028 election process for the presidency, once they go in and figure out what they're going to do with Social Security, I think we might start to get a little bit more realistic picture of inflation and what's happening. All that being said, yeah, it feels pretty rotten when your check is supposed to go up 2.7% or whatever, and it ends up going up 0.7% because you got dinged on your Medicare Part B, which you've been paying into Medicare your whole life already. Why you're paying anything is another question. But it's pretty early in the year to jump up on the soapbox, so I won't do that too quickly yet. We'll save it for next week.
Talk with Jake Floyd at Floyd Financial Group, and we're talking about current event headlines here. If any of this sounds familiar to you, market ups and downs and lower interest rate, concerns about income lasting as long as you do, there's an easy next step that our listeners can take, Jake, and that is the team at Floyd Financial Group offering this retirement review. Simply call us, no cost, no obligation, no sales pitch, just a chance to look at your situation and see if your plan really lines up with today's economy and today's headlines. So if you'd like some clarity, call 417-889-7233 and request your Floyd Financial Group retirement review, 417-889-7233. Absolutely no cost, no obligation, no judgment. We'll meet you where you are. 417-889-7233, also online at floydfinancialgroup.com. Time for a break. When we come back here on Show Me the Money, we're going to be talking about the fact that retirement risks have changed here in the last 15, 20 years or so. When our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about retirement risks that didn't exist 20 years ago.
And Jake, retirement planning used to be fairly straightforward. Income planning, tax planning, Social Security optimization. What has changed, Jake? Why is retirement more complicated today than it was, say, 20 years ago?
Well, I mean, if we can get rid of some of the fraud in these Somali daycares and leering centers, that might help. But I do think some of it is government has gotten progressively bigger and overreaching. And that has a lot of implications on Social Security and concerns about Social Security. But I also think that living longer and people generally having a better standard of living has created different kinds of demands on retirement savings than there was in the past.
So, Jake, people used to retire and they expected 10, 15 years or so. Today, it's not uncommon for people to live 20, 25 years in retirement. When you do a retirement plan, how long do you run these plans out for? I mean, do you run them to 75? Do you run them to 100? How do you figure out how far to run them?
So generally speaking, I plan on people living to 95. Now, there are situations where I plan further out than that, longevity in your family and that kind of thing. But for the most part, most people do not believe they will live to 95 unless they have, like you, Jeff, an aunt living that's 107, right?
Yeah, she was just turned 108 last Thursday.
108 now. Wow. So that's pretty rare. I do see people that are 100 occasionally. But generally speaking, if you have lived a good full life to your 95, the chances of you doing a whole lot after that in your life where you need a lot of income and things like that are not as high. But some people are planning for a 10-year retirement, which sounds good on the front end because you can spend a lot more money. But what happens if you're still here 10 years from now and you need money? So I want to set up a plan that's going to take care of you to the 99th percentile of how long you can live. I don't want you to ever run out of money. In fact, in most cases, what I want to do is leave you better than I found you 30 years from now.
Well, as you said, 20 years ago, people lived a certain amount of time, but today you can tack 10, 15 years onto that because of just better health, nutrition, better medical care, and so forth. So, yeah, I think there's nothing worse than running out of money before you run out of life. Another big change that people have to consider here, as opposed to 20 years ago, is the fact that adult kids are living with their parents. About half of parents are financially supporting at least one child. How does that affect retirement?
Yeah, what were we looking at? This is a couple of weeks ago, and Randy was here. He was saying that the new accepted average age that your kids should stay with you is till like 28 or something like that. That's just crazy, man. I mean,
I know.
I think the part that's maybe even more crazy than parents allowing that is actually that the kids want to be there when they're 28.
Oh, man, 19,
You know-
I couldn't wait to get out the door.
Well, and I also think that your generation and even my generation, there was times when I was 15 where I was threatening to leave early. I was like, I want out of this place. So when I turned 18, I ended up going to college, but
Yeah.
had I not gone to college, I would have just moved out. I wouldn't have been
Yeah.
just sitting around my parents' house and working. And it's strange to me that people do not want to have a sense of independence. And another place you see this is kids don't want to drive. A lot of kids don't want to have a driver's license. They're afraid to drive, or they just don't see the need. Again, I could not be restrained. I just could not wait for my 16th birthday. I had a job when I was 14, so I could put wheels on my car and put a sound system in it. So as soon as I was old enough to drive it, I could jump in there. So I think that's a big part of it. Living longer, but supporting adult children takes a huge toll on your retirement savings. Part of the reason most people don't have money before they're 40 is because they're raising kids. They haven't had the extra money. So if you're now raising kids till you're 50 or 55, the deck is just stacked against you.
Yeah, and about 60% of those parents admit that they're sacrificing their own financial security. That can be very, very dangerous. You can help your kids, but you can't make them your retirement plan. And I think that if you do support kids, again, this sounds like an old person talking, that you're really doing them a disservice because you've got this safety net. What happens when you're not here? They're going to be very ill prepared to deal with life. A third of adults 18 to 34, according to stats, are living with their parents right now. 40% of parents with boomerang kids say it impacts their retirement goals. And that's why planning has to reflect real life, not just spreadsheets. But also we're in this sandwich generation, Jake. Now we've got parents, aging parents that we're taking care of in addition to the kids. How much of a problem is that?
It's a big deal, Jeff. And I see it every day where people are not only going broke taking care of mom and dad, but they are putting themselves in the nursing home right next to them from a physical standpoint. If you're 60, trying to work a job and trying to take care of mom, and you're just a nervous wreck, especially if mom has like dementia or Alzheimer's, they can be a real big deal to deal with. And from a money standpoint, from an emotional standpoint, from a mental standpoint, and then occasionally you have somebody who has early onset Alzheimer's or something, so they're 65 with Alzheimer's, which means their 45-year-old kid's taking care of them while they still got their 25-year-old in the house. So they're taking care of the kids and the parents at the same time while trying to work a job. I mean, that would drive anybody insane.
Jake, is there anything that you can do? And I know that you've had these conversations in the 19, 20 years that you've been with Floyd Financial Group. But what advice do you give to people? Have you had people come in and say, Jake, I'm a little worried because my 28-year-old son's living with us and I'm taking care of my 70-year-old parent? What advice do you give to people like that, or people listening who might be in that situation sometime in the future?
So every situation's a little bit different, and I don't want to sit here and go, hey, there's no situation where that's okay, because that's not true. But yes, I play counselor quite a lot in here, where I'm supposed to be financial advisor, but there's lots of times where we get into discussions like that. I think a lot of people are in denial about how much it's hurting their retirement. And so if we spell out on paper what's happening to them and that they're behind on their savings and that means they're going to be forced to live on a half of the income they're used to living on, then they're like, whoa, that's not good. We got to do something here. And to your point earlier, it's kind of like spanking your kids, or at least disciplining your kids, right? If you don't discipline your kids, do you really love your kids? If you just want to be their friend and you don't want to be their parent, my pastor said one time, and this has really stuck with me, he said, your job as a parent is to work yourself out of a job.
Yeah, exactly.
Right? You're to raise an adult, not a children.
Mm-hmm.
If we're going to do that, at some point, you may have to have some tough love and say, hey, no, I'm not going to give you another $1,000 this month, because at some point you have to learn to stand on your own 2 feet. And sometimes that's going to have major consequences for them. Sometimes tough love is the love that people need. Now, again, I don't want to sit here and say there's no situation where it makes sense, right? If you have a kid that has special needs, or
Sure.
There are people that just simply can't tell their kids no. And no is an important word to learn as a parent.
Yeah, and I think if you have an able-bodied adult child who's living with you, and for those people who are listening to the program today and they say, hey, that's me, what do I do? You certainly don't want to throw them out on the street, but hey, here it is, January the 10th. Maybe you say something like, son or daughter, I love you very much. You know that, but you also know that you can't live with me forever. So here's what I'm going to do. I'm going to give you a 90-day notice right now. Okay, January, February, March, by April 1st, you're going to be on your own. I can't support you any longer. You can always come back and visit or have dinner with us. We'd love to see you. We'd love to have you here with open arms, but we cannot support you any longer. I'm doing it for your own good. That is tough love, and I think that really is the most important thing that you can do for someone.
I think also, too, Jeff, it's something that's important to pray about.
Yeah.
And again, I'm not really here trying to be Dr. Phil or anything, but I do think that you got to pray about this stuff. You know, God can help you sort through what you need to do and how you need to do it if it's something that even needs to happen. Again, I'm not telling you what you need to do. I'm just saying if you're ill prepared for retirement and you have to retire, you're not going to be able to support the kid then at all. So there's definitely some soul searching that needs to be done on that front. Talking
with Jake Floyd of Floyd Financial Group, we're talking about how retirement today is different than it was 15, 20 years ago. And again, the phone number, 417-889-7233. If you feel that your retirement plan is lacking something, it's not keeping up with today's times, call us here at 417-889-7233. Request that appointment with Jake. No cost, no obligation, no judgment. He'll meet you where you are and talk about how we can adjust your retirement plan to fit today's times. Okay, let's wrap up this segment by talking about exploding healthcare costs. Jake, you were talking about 5, 10, 15 years ago, 20 years ago, healthcare costs were quite a bit less expensive than they are today. I don't see them going the other way either. They're not going to be reduced, are they?
It kind of depends on how we go about fixing some of these problems. I would just say that a lot of the problem, especially in Springfield, Missouri, is the HMO and PPO organizations. You basically have Cox and Mercy, and that's it from a health insurance standpoint and from a care standpoint. And so because of that, they don't have enough competition to actually create reasonable prices. At the same time, you have government health insurance, which has totally messed everything up, where there's no competition in the insurance world either. Prices are totally unchecked on two fronts. And I would say that in the last 20 years, healthcare costs are probably 5x what they were 20 years ago. I don't have a statistic to show that right here, but I bet it could be even more than that. It's a lot more, not just like a little bit. So looking at these numbers, what makes America great is competition. That's what makes capitalism work.
Sure.
And if you take away the competition and we turn everything into socialism or communism or whatever, then the problem is you have costs just spiraling out of control. Now, if you go to the ER for a few stitches, it's going to cost you $6, $7, $8, maybe even $10,000.
Yeah, it's crazy.
I mean, it's just insane. And you're there for like 2 hours. They're getting $5,000 an hour for you to be there. Something has to give at some point. And the problem is what they're doing is instead of fixing the problem, they're just making it so more and more people are on government health care, basically, where they're not paying anything for the care. And it just keeps adding to the problem. It's getting reverse subsidized to continue to exist. At some point, we will hit a tipping point and we'll have to just rework this whole system. And I feel like we're getting pretty close because some of these Obamacare health premium increases have been just astronomical this year. Some people got like a 32% increase on their health insurance. They're paying $1,700 a month for a $19,000 deductible and 80/20 co-insurance. It's out of this world. So I don't know that I have all the answers, but what I would say is we need competition. We need the ability for a doctor to go hang a shingle and compete with these big organizations. While they're still going to be necessary, we need more players to come together and have either competition through price, competition through better service, or whatever it may be. But that's really, I think, the issue with healthcare.
Well, people are living longer with chronic conditions today, Jake, and of course, Medicare helps, but it doesn't cover everything. So I think the answer to these exploding healthcare costs is to account for those in a financial plan so that you do have money to pay for those copays. And remember, a lot of people need hearing aids, and Medicare does not cover those $5,000, $6,000 for that. Dental coverage also. Many, many things Medicare doesn't cover. Talking with Jake Floyd at Floyd Financial Group, we're talking about how retirement today is much different than it was 20 years ago. If you feel your plan is outdated, call us here at Floyd Financial Group at 417-889-7233 and request your Floyd Financial Group review. No cost, no obligation, no judgment. 417-889-7233. We'd love to hear from you. Jake, time for a break. When we come back here on Show Me the Money, we're going to be talking about inflation and interest rates and more when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about how to prepare for potential inflation this spring and beyond.
And Jake, President Trump has said he wants interest rates down to 1%. Do you think that would create inflationary issues?
Jeff, I don't personally think so. I don't think that we're going to see inflation get out of control. And that's largely because, and we've talked about this before, but I want to make sure that new listeners get this. So if we're selling widgets, whatever that widget may be, and they're $1 a piece, and let's say right now it costs 70 cents to make that widget, all in, net profit margin of that extra 30 cents there. As time goes forward and as AI comes in, we're going to have less labor, and even the labor that we have will be more efficient. So over time, the cost of that widget will go down from 70 cents to 60 cents to 50 cents to 30 cents. And even if there's only one player making that widget at the time, right now he's making 70 cents per widget instead of 30 cents, which means what? Other companies are going to look around and go, hey, I want to make widgets too. I want to make 70 cents a widget. So they come in and they say, hey, I'm going to price mine at 99 cents per widget, and I'm going to do the same thing this guy's doing. Another company comes in and say, hey, I'm going to do it for 89 cents. We're going to cut this cost. And then pretty soon that widget goes from $1 to 40 cents per widget, and the profit margin remains roughly the same, but the cost of whatever that is went down significantly. Now that's going to happen to 50 to 70% of goods, maybe not to that extent, but the costs are going to come down to make things. And while some of that will directly translate into profit margins, some of it will translate into lower prices. As that happens, that's a huge deflationary pressure. And I am predicting personally that I think that we will have trouble coping with how much deflation that is, and that interest rates will come way down. Now, again, that doesn't make me right. That's a prognostication on my part, but I think that costs are going to come down in a big, big way. And things that used to cost a lot are going to really come down in price. Imagine if every vehicle driven by UPS to deliver packages is now driving itself, and you have no more drivers. What are they going to do with all that money that they're saving on $100,000 a year on a driver in New York City or wherever, times 20,000 drivers or however many drivers they have? All of a sudden, they have just money flowing everywhere. So two things are going to happen. The cost to ship a package is going to go way down because UPS and FedEx and USPS and DHL and everybody else will be competing for it. But those companies are also going to make more profit. As we're looking at the overall inflation picture, that is my opinion on it. So I am not super worried about inflation. Again, there could be some inflation in the short term here as we're grappling with this problem, but I really think over the next couple of years, we're going to have such deflationary pressure. And I think that's why Donald Trump is focused on having lower interest rates, is because he knows this. He knows we're going to have all this deflation. He's not super worried about inflation spiraling out of control. He's more worried about paying $1.2 or $3 trillion a year on debt service. And if we can get that number down, that'll help us pay off our debt.
And Jake, President Trump, as I said, wants inflation around 1%. And it was just as recently as the last couple of months, I'd heard that 2% was the goal. I've also seen it written that it's sort of like Goldilocks. You want it just right. 2%, things grow steadily. 0% inflation or negative, you risk deflation or stagflation. Falling prices, wage pressure, delayed spending. 4% or higher, affordability collapses, and rates must rise aggressively. And again, I've seen it written that we've seen this before in terms of the Great Depression or Japan's lost decade. What do you think about that comparison, or is that an accurate comparison at all?
Well, I think that that's what they're going to be worried about, and that's why interest rates are going to remain low, in my opinion. Now, I don't think it's necessarily a founded concern, because if this was just happening on its own with no AI, with no innovation, it would be very concerning. Really, the last time in history we have to compare to what's happening here is the Industrial Revolution 100 years ago. So the Industrial Revolution, in a lot of ways, created the Roaring '20s. So the question is how long does this last? How much money can we make in the short term? And then how do we protect it for the long term? Those are the things I'm thinking about all day, every day. That's what I'm building plans around here. We need plans that work in great weather, and we need it where it works in the thunderstorm. We don't know exactly what's happening and when it's coming. So we need a plan that's ready for all of that. But like you said, inflation is like Goldilocks. 2% is the target. 1.5% isn't enough, and 2.5% is too much. I think that that's how the Fed paints it. I don't know that that's necessarily true. Running at 2.7% inflation or whatever we're at right now, something like that, is very sustainable. There's nothing wrong with that. For a long time, from 2010 to 2022, we were trying to get to 2% inflation. We were at 0% interest rates most of that time, printing money, and still we're at like 1% inflation. We couldn't get up to 2, and now we're trying to get back down to 2. So this is why the Fed chair pick is going to be so important, is how that Fed chair views inflation and what the target should be and what the tolerance is for undershooting or overshooting in the medium to long term is really going to shape policy in a lot of ways over the next 2 to 5 years.
Jake, when you do retirement portfolios and you do income plans and you take a look at expenses, what sort of inflation do you build in to hedge your bet to make sure that people have enough money or more than enough money?
Yeah, so when we're thinking about inflation, I use a lot of the long-term averages to kind of stress test portfolios. If we're looking over the long haul, inflation's run like 2.3, 2.4%. Yes, we've been way above that recently, but prior to 2020, the previous 20 years, we were way below that in a lot of cases. We can't really account for 8% inflation anyway, because you're going to need, if you know how the numbers work, that means we're going to need like 5 times as much income 25 years from now. You're just not going to be able to produce out of a portfolio, but we need to make sure we leave room in the plan to increase you over time to some extent so that you can grapple with costs looking forward. Having a plan laid out, ideally before retirement, but certainly if you're looking at retirement, getting a feel for how much income you can reasonably expect to produce, how much inflation you can count on being able to grapple with, meaning increasing income over time, is a big part of that.
Jake, is inflation more dangerous early in retirement or late in retirement, do you think?
So the numbers will be much bigger later in retirement, but it's also likely that you will not be wanting to do as much later in retirement. Probably somewhere in the middle. 10 or 15 years into retirement is where you're going to feel it the most, because you still, at that point, maybe have your health and you're wanting to still travel and do things with the grandkids and all that. But you're going to have had some fairly significant inflation impact to your income 10 or 15 years in. By the time you get to 30 years in, the impact is greater. But again, if you're 90 or 95 years old, those are not your go-go years anymore. I'm less worried about that than I am making sure that you can live the best life you can live while your health allows it, those first 10 to 20 years or so into retirement.
How much do you think we're going to need to account for inflation over a 20-year period?
You know, that's a really hard number to pin, Jeff, but I think that, in my opinion, the next 5 to 10 years, we probably won't have a lot of inflation. However, after the growth has all run its course, and after AI has taken over everything, every facet of our lives, and after we've printed all this money trying to prop up the economy while inflation is low, eventually that will hit a tipping point and we'll probably have some inflation. There's so many factors that are going to play into that. I don't even really want to speculate a guess, but I would say that 20 years from now, we need to make sure we have at least 50 or 60% more money to live on. It may be higher than that, but I think that's a good goal. And that doesn't all come from your retirement savings, right? Social Security or whatever is happening with Social Security will also increase to help offset some of that. But your spending will also go down over a little bit over that 20-year period. That's a really hard number to peg, Jeff, but I would just say I probably think that number's lower than most people would say, simply because of my view over the next 10 years of what's going to happen in the economy.
What's happened in the last 20 years, Jake, is that any indicator of what's going to happen in the next 20 years, or has this just been an anomaly?
History is always a guide, but I don't think the next 20 years will be like the previous 20 years. I think that we're going to have an ease of life that we've never seen before, because so much of what we do on a daily basis will be done for us 20 years from now. It's very hard to speculate about because it's hard to guess the timing and everything, but I think a lot of that is going to be very deflationary. Again, it depends on our response to that deflation. If we print a whole bunch more money, that definitely could come with some inflation. My guess would be 50 or 60% more than we have now is what it'll take 20 years from now.
Talking with Jake Floyd, Floyd Financial Group. And once again, if you're hearing the program today and you're worried about inflation this spring or worried about inflation over a 20-year period, that is your retirement lifespan, give us a call here, Floyd Financial Group at 417-889-7233 and request your Floyd Financial Group retirement review. No cost, no obligation, certainly no judgment. We'll meet you where you are. 417-889-7233. Get 2026 off to the right start and take advantage of the opportunity that we're extending to you right now with Floyd Financial Group's retirement review. Again, it's not going to cost you a dime. 417-889-7233. Jake, time for a break. When we come back here on Show Me the Money, we're going to be talking about retirement risks that your plan must address when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about retirement risks that your retirement plan needs to address.
And Jake, we're talking about something that every retiree and pre-retiree needs to understand, the biggest risks that can derail retirement. This is a critical conversation because I think that most people focus on returns, but retirement success is really about managing risk. Now, we talked about longevity risk earlier, the fact that people are living much longer. It's good that you're living longer, but the bad news is that now you have to stretch your money out to cover those years. 25, 30 years is not uncommon today. But I want to jump into market risk. Market risk is something that investors are used to, but retirement changes the rules. Jake, why is market volatility more dangerous later on in life or in retirement?
Yeah, time is just simply not on your side at that point, right? And as you're in your accumulation years of your retirement assets, then you can afford for the market to take a dip and come back, and you can wait. The problem is once you start taking money out, you really can't afford to have those dips, and you can't afford to have to adjust your lifestyle based on how the market did that year. And because of that, if you don't want to reduce your income when the market's down, we really need to make sure that we address market risk in a way that will put a floor under some of your money so that you're not feeling every vibration of the market, or you're not feeling it as much, right? Because if we have a 30% downturn when you're accumulating money, you can afford to have it come back. If you're taking 5% out of your retirement assets and it goes down 30%, well, now you're taking 7% of your assets instead of 5. Again, it's a little bit more than that without getting the calculator out. Something like 7%. Thinking about that, now 7% is too much. And then it's very difficult to get back to even unless you just have a really good market. And so dealing with risk, not only your risk tolerance, but also your risk capacity, how much risk you can afford to take, is one of the biggest things we spend time on when we're building portfolios.
And Jake, this one surprises a lot of people. It's called sequence of return risk. We've talked about this before on the show with Randy. Same returns, very different outcomes. Explain how that works.
Right. So if I have, let's say we have a 5-year retirement, just to make this easy, and the first year the market goes up 10%, the second year it goes up 10%, the third year it goes 0, the fourth year it goes down 10%, and the fifth year it goes down 10%. What happens to your retirement portfolio during that time frame is the same if we reverse those numbers. So it goes, first year it's down 10%, second year down 10%, and so on. It's the same outcome no matter what if you're not taking money out. However, if you are taking money out and you simply have the worst years first, that will make you run out of money much faster than if you have good years first. And so when we're talking about sequence of return risk, all we're talking about is, let's say that it's a given that we're going to make 6%. How that 6% comes in and when it comes in is a very important piece of the puzzle. And that's a risk that most people don't even know is a risk, especially if they haven't been used to taking money out of their portfolio.
So bad markets hit early in retirement while you're withdrawing income. Your portfolio may never recover, even if the average returns look fine on paper. Jake, is this where guaranteed income comes in again?
Sometimes. It depends on the situation. It depends on how much money you have saved. It depends on how much income you're wanting to have in retirement. So that's why it's so important that I get to know each person before I give specific advice. What's important to one person is not important to another. I have people that live on $2,000 a month in income and have money in the bank and really don't want to spend it. Some people can't even fathom living on $2,000 a month. And if they did live on $2,000 a month, they'd certainly be tapping their retirement income to help supplement. It's not important to some people. It's more important that they leave money. But most people want to have a good retirement, and then leave what's left over to the kids. If that's you, we can definitely work through that. But I have to understand each person before I can give them good advice. All these things we've talked about today are things that we take into account during the planning process.
Talk about retirement risk that you should be aware of with Jake Floyd of Floyd Financial Group. And Jake, taxes don't disappear in retirement. In many cases, they actually increase. How can they increase, and what should retirees be watching out for?
Yeah, I would say for the average person, they're going to go down a tax bracket if they've been used to two-family incomes and their white-collar type jobs and things like that. But there are people who have saved well and live frugally that have a lot of retirement money. And when RMDs kick in, they have to take all this income, and all of a sudden they're paying huge amounts of taxes. So when we're thinking about taxation, number one, we need to understand what's going to happen to us in retirement tax-wise. If our income is going up due to RMD or other things, then we have to worry about things like IRMA, where we have to pay more for Medicare Part B. These are pitfalls I can help you avoid, or we can at least take them in stride. If you're going to make $500,000 a year in retirement, you're going to pay more for Medicare Part B no matter what we do. To an extent, there's a lot of planning techniques that we can use to keep income at bay. Another thing we can look at, if you're really not looking to spend money in retirement and you have a lot of IRA money, potentially converting over time to a Roth could make sense. Now, again, people that know me know that I'm not a fan of blanket Roth conversion, and I'm definitely not, but there are situations where converting to a Roth can keep you from having huge tax bracket increases every single year as you get into RMD age based off of mandatory withdrawals. There's a lot of things we can look for, but each person's situation is so different. It's something we have to talk about in person.
And Jake, we talked about interest rates here and what they may be here in 2026. They affect more than just the borrowers. How do interest rates impact retirees?
If you have a retiree that was retired prior to 2007, you can ask them what happened to them in 2008, 9, 10, 11, and so on, right? Where they went from making 4 or 5 or 6% on CDs, and now they're making 0 for a decade. If you're a saver, interest rates will affect you more, certainly negatively affect you more than most people. But if you're invested in markets and things like that, lower interest rates can be a good thing, because lower interest rates drive commerce, drive business, stocks, bonds, so on. Even real estate tends to do well with low interest rate environments. So it's really, if you're just used to sitting on CDs or savings accounts, that you really need to watch the interest rate environment, because if you go from making 5% to making 0%, where are you going to come up with that income to live on? When it comes to bonds and things, bonds are inverse to interest rates. So if interest rates go down, bonds go up. So that's a tool we can use right now if we are expecting interest rates to come down. But again, it really depends on a lot of other factors, but that's something we can look at.
Jake, let's talk about a risk that a lot of people don't want to think about, but for many it is a reality, and that is long-term care. How do we handle long-term care?
That's a good question, Jeff. And in a lot of cases, it's getting so expensive that it's very difficult to account for with the average person's retirement savings and that kind of thing. So again, this is another situation where it really depends on what kind of money you have, meaning what classification. If you have a lot of after-tax money, there are estate planning attorneys and things that do trusts that can help protect some of that money. There are insurance plans like long-term care insurance, but also asset-based long-term care insurance where we can set aside a certain amount of money and leverage it against care costs. We can even do that with IRA money in some cases. Trying to figure out how much care is going to cost when it's gone up. Even since I've been here, I remember in rural areas, it was about $100 a day for full-blown nursing home care, and now it's about $8,000 a month. It's almost tripled in the last, let's say, 17 years or so. It's a big enough number that's hard to account for, but if that's something you're concerned about, I can show you some options that will maybe not fix the problem totally, but will allow us to really leverage your money, make sure you have as many options as possible. Nobody wants to go to a nursing home. If we can stay home as long as possible, home care, then maybe assisted living, and finally a nursing home. Not only can that help keep the costs down, but it can help keep you comfortable longer too.
Jake, why is a long-term care insurance policy not necessarily the answer for a lot of folks?
A traditional long-term care insurance policy, my biggest reason for it is not the reason most people would give, which is that, if you don't use it, you lose it in many cases. My problem is the ever-increasing cost of it. There's no cap on what an insurance company can charge you for your long-term care insurance premium. So if you start out at $200 a month, it may be 10 years from now $300 a month, and they'll keep raising your rates. And about the time you need it is when it's now $700 a month or something crazy. And so I don't like the idea that I can't see the future of what they're going to charge us and decide whether that's worth it ahead of time. You just have to hope and pray that they don't gouge you too bad on prices. So I don't generally like that situation. I don't like anything that we can't control or change. So generally I like asset-based care, or again, attorneys, estate planning attorneys. So my wife is an estate planning attorney who does this kind of work, but there's others around town too, can do certain types of trusts that can help shield assets. So again, it kind of depends on your mix and what you have and how we go about protecting it. But that's something we can talk about when you come in for your consultation.
And Jake, Randy, and I have talked before in this program about how to save the family farm from the nursing home. He's talking about Medicare and Medicaid. Now, for those people who do not listen to the program on a regular basis, you and I know why Medicare is not an option. But can you explain to those people who think, well, Medicare is going to pay for the nursing home? It's really not going to do that, is it?
It's definitely not going to do that. It might do that for the first couple of months. That's about it. Once you're no longer getting better, Medicare covers acute cost. So things that you're going to get better from. Once you stop getting better, you're going to be either on Medicaid or on private pay, and the bill goes up pretty quick. There's a lot of people that think that it's going to cover them ongoingly and that Medicare is going to take care of you in a nursing home, and that is definitely not the case. You will be in for a very rude awakening when you start to get those bills. But there are ways that we can plan around this, and depending on your situation, whether you're married or single and that kind of thing, those things all play into how we go about planning around this situation. Which money we spend first in these situations, meaning like if you're in retirement, let's say you got half your money is after tax and half your money is retirement money. As we spend money, we have a choice as to which bucket we spend it out of. And we can spend them together. We can spend one and then the other. If we spend IRA dollars first, then that leaves more non-qualified money or after-tax money that can be put into trust or other things to help it be shielded from these costs so that, again, we don't lose the family farm. Because there's a lot of people, they're kind of cash poor and land rich, right? Mm-hmm. Those are the people that this affects the most, where you may not even be able to afford to go into the nursing home because of what it would do to the farm. And I've seen many, many people have to sell their farm because Medicaid is not going to pick up the bill if you still have a farm out there in your name, and they will force you to spend it down. And so if we can do things ahead of time, plan ahead of time, there are different ways to title the farm, like in an irrevocable trust or things like that, where if we do that 5 years ahead of time, then that farm can be totally held harmless from a Medicaid situation. Now, again, there's a lot of considerations here, and I'm not an attorney, but this is something we have quite a bit of experience in dealing with and around when it comes to trust work and nursing home costs. Again, the best thing I can tell you to do is come in and talk to us. We do a free consultation, and we will just simply get to know one another. We'll have a cup of coffee, and you'll have a chance to ask whatever questions you have, and I can weigh in on what the best way to handle some of these things, in my opinion, is, so that we can give as little money to the government and the nursing home as possible.
That's right. And as you said, there is a look-back period. You can't just retitle things today and expect your farm to not be subject to the nursing home tomorrow. So you got to get ahead of it, and that is why we're offering this Floyd Financial Group Retirement Review, so that you can get ahead of all these things. As Jake said, no cost, no obligation. 417-889-7233 is the number. If you've got questions about anything that relates to your retirement journey, call us at 417-889-7233. Set up your consultation with Randy or Jake. No cost, no obligation, no judgment. We're also online at FloydFinancialGroup.com. Well, Jake, we're out of time for this week. I want to thank you for your time, but most importantly, as I do every week, I want to thank our great listeners here in the last bastion of sanity, Springfield, Missouri, for joining us. So for Jake Floyd, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.